Hello, I'm Effie Zahos, Chief Content Officer and Money Commentator at InvestSMART Group.
And I'm James Thomson, Senior Chanticleer Columnist at the Australian Financial Review.
And we are...
The Money Cafe.
I got it right after the second go. Too bad that you're cutting this gig for me next week.
How are you, Effie?
I'm well, James. It's a real pleasure to be chatting with you on your podcast.
Yeah, same. Thanks for joining us.
And we've had a busy week, haven't we, as far as data's concerned?
It has been a busy week. Well, every central bank in the world seems to want to be in on the act. And so we had the Fed last Thursday morning, our time, go with a 50 basis point or 0.5% rate cut, which was a bit of a surprise because that sort of rate cut's only generally reserved for emergencies. I don't think we're in much of an emergency. The US economy's traveling pretty nicely. The stock market's at all-time highs, and yet here we are with a 50 basis point rate cut. So, and
it's given our dollar a nice little push up too, hasn't it?
It has, yeah, absolutely. A bit of good news for the travellers.
And also, I mean, I guess a little bit of good news for us on the inflation side. If we're importing a lot of goods, I would have thought that could be nice for us in the sense of lower prices.
Yeah. No, I think every little bit helps, and the RBA needs as much help as it can get at the moment. So, look, they're not going to be too upset about that. Although I guess they do have this issue of, do they want to be caught too far behind the Fed's rate cutting cycle? And obviously we had the RBA decision on Tuesday.
What's your take on that? What are your thoughts?
Oh, I thought it was sort of largely as expected. The Michelle Bullock post-meeting press conference is sort of turning into a bit of a game of chess. You know, how to say nothing in 45 minutes.
And she does a brilliant job of it, actually.
She does fantastic. She takes every question in the room. She's been so impressive.
She has. And to be fair, I'd far prefer the more, openness in communication, even though you are absolutely right, James. It is kind of dodging the bullet, so to speak, and answering a question, the same question in a number of different ways.
Yeah.
But it is nice that there is that open communication there. I guess you're right, 4.35, we're all kind of expecting it. It's the seventh board meeting that, they have not changed anything. They are really standing, firm along the lines of, we'll wait and see what the data holds. But there was a bit of a dig, I would think, more so on the government and what they're doing as well, I felt a little bit.
I think you're right. I mean, the frustration's probably been building for a little while.
Yeah.
We just, we've had in the last couple of weeks, Jim Chalmers come out and say, interest rates are smashing the economy. But, we had the jobs data last week, which showed 1 in 2 jobs are being created out of the public service broadly, and defining that as health and aged care and construction related to the public service. But it's government spending. It's fiscal stimulus that keeps pushing against what the RBA is trying to achieve on inflation. So
absolutely. And this is what I was saying, I think, to Stephen too, that you've got the RBA, they've got their foot on the brake. You've got the government foot on accelerator, and those job numbers, you bang on in the sense that you've got the public sector really keeping it afloat. The private sector, it's those mums and dads, those small businesses that are really hurting, not just so that they're not getting customers walking through the door, but they've also got to sit on these rate hikes for longer. And that's where the real, I guess, pressure is. We've got a slowing economy, and we're not doing much side on the productivity side. And it'll be interesting today to see those monthly inflation figures, what they come out, because it's all about, I guess, they're going to be good, but, good, how sustainable are they? And I think that was the other message that Michelle Bullock was saying with regards to the CPI numbers to come out.
Yeah, the monthly data is proving very, very noisy. It's jumping around all over the place, which is okay. It's a relatively new data set, and it's got to sort of we've got to persist with it to make sure that it'll get better over time. But yeah, the RBA would love a bit of inflationary good news. Effie, you spotted some interesting news out of that jobs data about side hustles, second jobs. Is this a trend we're starting to pick up on?
Well, look, we know what even official numbers are showing, that more and more Aussies are taking on a second job to either pay for their mortgage or keep up with the cost of groceries. And I know we're going to chat a little bit about Coles and Woolworths later on.
Yeah.
I'm always getting into trouble, these guys. But yeah, I spotted some interesting data to come out from Airtasker that just showed there's about 6.2 million users now on their platform. So for those who don't know what Airtasker is, it's basically a platform where you can put your services to, sell your skills, so to speak, or if you're on the other side, hire someone to do some, tasks maybe around the house or whatever you need. I have definitely used Airtasker. They've seen 80% more yearly registrations, and they're saying that they have put about $600 million into the pockets of taskers this year. So that's an obscene amount of money going in as side hustles. But what surprised me is that even looking at, say, their top earners, the top 10 highest earners, they earned collectively $250,000, James, in the month of July. Just their top.
Wow.
I might be in the wrong business.
Yeah, maybe. Do you think we can, 40% increase in sign-ups in the last week of August? Is that people starting to really hurt, do you think? I mean, it's anecdotal, I know, but it's people trying to find another little source of income, isn't it?
Yeah, absolutely. Like I've kind of covered this quite a bit, even on Today's show, using their data. And it is people that, we're in a situation where we want to work full-time or more, but can't get that. So we're using this as a way to supplement maybe our existing job. In other cases, people are turning this into their full-time careers. But it's definitely a way to keep up with the cost of living. When you look at, 13 rate hikes, what's that done to the average, mortgage there? You need to spend about $50,000 a year on your mortgage repayments, and that's income after tax. We kind of forget that, James. Basically, you've got one person in your household working a full-time job just to keep up with those mortgage repayments. And it's interesting that the jobs that are paying the most, actually, you don't need a degree, or you do definitely need skills, but it's something that people can jump in and think, yeah, I actually do like a bit of gardening, and I can do that on the side, and I could have an office job, and it complements it. So, the highest paid categories, apparently we all need fences for some reason. So constructions, landscape, a bricklayer, demolition. But the ones that are in high demand, and this job has been in the number one spot since I've basically been reporting on Today's show for over 4 years, removalist. I don't know where we're all going. We may be going to Queensland, but removalist is number one.
There you go. Maybe we should stop talking about this, Effie, because Alan might get an idea of air tasking podcast co-hosts. If we're not.
You might put you out, yourself, not me. I'm here temporarily.
If you can't do the sort of if the air tasking thing, perhaps you don't have time for that, or what are some other money hacks? As you said, seven rate cuts, 7 rate decisions on hold. It doesn't look like we're going to get a rate cut until well into next year. What have you got for us, Effie?
Yeah.
How do we save some money?
Absolutely, James. So let's start first with the interest rates, because as you said, we probably won't get a rate cut. It really does depend on this data coming out. Today we'll have more of an insight. We've got to remember that the RBA doesn't meet as often as well. And I think there's only one major bank now still hanging on to a possible rate cut this year. That's CBA is probably suggesting maybe one in December. And then they're saying five cuts in total, down to 3.1. Then you've got others, suggesting maybe the first one may not be until May.
Yeah.
Whatever the situation is, for every, say, cut of 0.25%, it's going to put about $100 back into your pocket. And this could take months and months before we get there, because, as I said, the RBA just doesn't meet as often now. If they don't move in November, December, there's nothing in January, February, March. It will take a while until we actually see this filter through. The most important thing to understand is that, boy, you can actually give yourself a rate cut right now. I was looking at some data to come through CanStar there, and basically there's been a lot of movement with rates anyway. 48 lenders since January have cut their rates by 0.21. There's been a lot of movement in fixed rates, fallen. About 61 lenders have dropped by 0.44. Now, I suggested probably 4 or 5 months ago that you could actually get a quick win. You could, for example, depending if you're on the average variable rate of 6.87, you could have locked in for 1 year at, as low as 5.74. You'd need, 4 or 5 rate cuts before you're saying, oh, gee, I've done the wrong thing. That window of opportunity is probably closed now because fixed rates, situation here is that if, the RBA will be probably, having 4 or 5 rate cuts, you may have missed the boat now to lock in. Right. But there are plenty of loans still in that 5%. So obviously give yourself a rate cut, but some really easy ways of saving and some money hacks that I've found are things like, I know you're always told, I don't know about you, James, but when you shop, do you keep things in your basket still?
Online?
Yeah, online.
Yes. Usually I'm abandoning the cart because I feel guilty about buying that thing that I don't really need. But yes, I do. And then I get follow-up emails from the people often saying, hey, you've left something behind. Am I doing the wrong thing?
No, you're absolutely doing the right thing, but you're probably looking at the wrong things.
Right.
So if you're looking at, I don't know, golf clubs or socks, whatever turns you on.
Records, usually records.
Records. Okay, that's your advice. It's interesting. I was doing some research in home and contents insurance, and you can go online and within moments you can actually get a quote for your home, your car, your actual contents insurance as well. And I keep those in there basically because I'm lazy to delete them, and they're sitting in my basket. And what I find within 3 or 4 days, a lot of them then come back to me and either sharpen the offer and say, hey, Effie, we'll give you a further 10% off. I've had up to $100 come back to me. Oh, take the insurance and we'll give you a $100 gift card. And I've really just done these quotes for research, basically, to have a look, because I'm quite happy with my home and contents insurance. But I was quite surprised by leaving them in the basket and just forgetting about it, really, because it was more for research. They're coming back to me now saying, hey, we noticed you were looking at this quote 3 days ago. Can this tempt your offer? So that's a little hack that I would suggest you do when you're looking at your home and contents insurance, because they've gone up like around, 20% in some cases, policy. So it's worth looking at that.
I like it. But a bit of a reward for laziness. We don't get that often.
Who said the lazy tax? This is a way to actually get something back. And the other thing that really bugs me is insurance premiums. Try not to pay monthly, especially if you're getting penalised for it. In some cases, there's a $1,000 difference between paying yearly or monthly. And not that I'm an advocate of taking credit cards, because I did notice some data from Equifax too, with rates staying on hold. They're suggesting that more people will get through Christmas by racking up maybe small loans. It's interesting to know if you are being penalised by paying monthly. If you are really good at managing your money, you could get a zero purchase card, one with no fee, pay your insurance that way, then pay that over 12 months rather than paying the premium to your insurer by going monthly. That's a little risky one, though.
Yep. I was had a dinner last night where there were some bankers from a couple of bankers who've worked at the Big Four and still there. Now, they were saying that most customers are checking their account daily and even multiple times a day online. Do you are you still an advocate though for sort of printing out the paper statement and going through it every month or every week?
I'm old school. Only because I'm more of a visual person. So for me, I would print out your statement, and maybe it's a quarterly statement. And I know that's a lot of paper. Reuse it. Don't send emails of complaints to me, please. But I would. I basically have 2 highlighters. One color is fixed costs, and the other color is the discretionary. And that is really more of a nudge for me to realize, oh my goodness, that discretionary color, it's a sea of it, And then I realize, okay, I've got to get my tap and go under control. There's a lot of discretionary spending happening here. And let's not forget, we're getting slug merchant fees on that too. And then I do go line by line through those fixed costs because, things change. When you look at, say, even the energy market, there are deals happening there all the time. Look at your mobile phone plans. And one that I'm, passionate about is that a lot of us play with the major players. So it's, Telstra or Optus because we like the service. But you could technically switch your phone from Telstra, go to, say, Everyday Mobile that uses the Telstra network, save $25 per month there on that plan, then save a further up to $50 because you get 10% off your shop. So that's a way of stacking your discount. So I do go line by line through all my fixed expenses. It's boring. I'm not going to be, I'm not going to lie, but it's not a bad, 4 hours worth of work. The return's pretty good on it.
Yeah, no, fair enough. And Effie, we mentioned Coles and Woolies before, so we're talking about discounts. Is there a time? What did you make of this story? So the ACCC's taken Coles and Woolworths to court, essentially alleging that some of their discounts weren't as tempting as first they first appeared. Basically, because they'd taken a product. I think the Woolies example was Oreos, and the Coles example was Strepsils throat lozenges. They'd held the price low for a long period, up to a year, and then they'd put the price up for 6 weeks, and then called it a discount or a down or a promotion. But the price was actually higher than that it was for most of the year. What do you make of this? It's not a great look, is it?
It's not a great look, and this could blow out quite big. This could be quite serious here because I'm reading reports, and there are some publications that are now saying were suppliers involved in this as well. This is going to be very interesting as it unfolds because essentially they're alleging that this is a form of price gouging. And they've been, sticking their heels in saying, no, we have not done this. So this is very disturbing. But, you ask your consumer, I can tell you now, they're probably going to say, oh, no, this has been happening. And it was interesting. Yeah. I went online and just to see what's happening on social media around this and the comments that are flying through. Here's one person saying, as a weekly shopper, this has been blatant for over the last 2 years. But they messed up things if they get fined, and they're only going to put up prices further to recoup the loss. So that's their concern that, now that they've been caught out, a price is going to go up. The general consensus out there is that, no, this has been happening. They've been doing it for a long time. Another comment was, they should have also been made to make a sign saying, look, smaller size for all the products that have increased in price but dropped in weight. And we've seen a lot of that shrinkflation.
Yeah. I think this is interesting, Effie. I mean, I think there's two tests here. There's the sort of legal test. So that will all come down to this idea of a very difficult legal idea of reasonableness. So to have a price discounted, the previous price has to be elevated for a reasonable amount of time. Now, the supermarkets have decided or have judged that a reasonable amount of time is sort of 3 or 4 weeks. Now, is that reasonable? Is it not? That's going to be an interesting level.
So they've got to have their recommended retail price. Is that what you're saying, James? It's got to be there for at least 3 to 4 weeks.
Well, that it's got to be there for a reasonable amount of time, and the supermarkets have decided 3 or 4, somewhere between 3 or 4 weeks is a reasonable amount of time. Now, I don't know. Is that going to stand up in court? I think that's what we've got to see. But Effie, I think that the bigger test here is the whole, I hate to use the cliche, but it's the pub test. Yeah. Like, this just isn't a great look. Coles and Woolies are usually really good on staying very customer focused. They talk a big game on this stuff. It's just a bad look to be fighting the ACCC on all this stuff. And do they really want this to go the distance in court and have the lid lifted on all their pricing strategies? I'm not sure. I reckon we'll get a settlement and a win for the ACCC here and some sort of penalty.
I think you're absolutely right. And I'm more interested to see how it actually does play out because, I mean, it could be considered even fraudulent behaviour here. And the fines, when you start looking at that, could be quite enormous. But you're right, it's not a good look. Especially right now, just coming off the back of what there are. So from a share price point of view, though, what do you think could unfold here?
I think there'd be fairly muted impact on the share price. I mean, no one likes regulatory uncertainty. I don't think the fines will sort of be crippling for them. I wouldn't expect that. The question, though, is whether this all leads to some sort of change in the way discounts and pricing strategies operate across the sector. Now, both Coles and Woolworths would be hit equally by that, but that could be something to watch, whether it gets harder for Coles and Woolies to run these discounts, whether they've got to provide more transparency around the discussions they have with suppliers. So I think that's the interesting
carry on to other industries too.
Yeah, that's exactly right.
Think of a few right now that really do work on the premise of sales all the time.
That's right. Should we go to some questions, Effie?
I would love to go to some questions, James.
But I think we've got to have a quick word from our sponsor before we do that.
Looking to level up your investing game? Join InvestSMART's Investor Bootcamp and master the basics of investing, develop smarter money habits, and learn how to build lasting wealth. You can go at your own pace over 3 months with optional live weekly webinars to reinforce your learning. Usually priced at $99, Money Cafe listeners can save $40 with the code MONEY40. Head to www.investsmart.com.au/bootcamp and use the code MONEY40 and save $40.
James, the first one's from Dave. He loves the podcast. His favourite every week. He's got a question around, he says he's a very patient shareholder. And how is it the case that a company like Qantas can turn off their dividends? He said he had strong growth in his Qantas share price, but that's not currency. He says he can use it at Dan Murphy, at least not without adding capital gains tax to the cost. And surely with all the profits that it has, 1.7 billion in cash, isn't there an argument now that some level of dividend should be paid? What are your thoughts?
Well, look, Qantas has turned off its dividend for a couple of very good reasons. One is that it had to get through the pandemic, and so it went into a fair bit of debt to get through that. So its focus has been paying down debt rather than paying out returns to shareholders. The other thing that Qantas has got going on is a massive fleet reinvestment program. So they are modernising their fleet, particularly across the Jetstar and Qantas domestic fleets. So that, again, is really expensive. I think, though, that they're intending to get the dividend going back again in the coming halves. So, Dave, a little bit more patience. But look, it is a good lesson. Like, dividends, even at big companies, aren't guaranteed. Sometimes a company will have other priorities that it will have to put first: paying down debt, managing through a difficult situation, or investing. So it is a bit of a reminder that, yes, I take your point that you can't use share price appreciation to buy a bottle of wine down at Dan Murphy's, but occasionally you'll have to be patient. It's just the way it is.
And its price actually has had a good run, really. When you think about what it's gone through over the past year, it's about 40. I checked it out this morning, about 40% increase year on year. So moving from $5 to $7. So Dave's definitely done well on the price there. But is it too late to jump in, do you think, James, on this? If you're sitting here now listening and thinking,
Oh, not sure, Effie. You put me on the spot there. I guess the one thing I'd say, think of the slowing economy more generally. There's been huge demand for travel post the pandemic. Is that going to continue? Not sure. But look, Qantas is clearly being run a lot better than it was 12 months ago.
Yeah,
so you can have some faith in that. Now, Noel says, I'm fairly new to investing, and your podcast has definitely filled in some of my knowledge gaps. I'm curious how some companies generate their value. For example, I believe Brickworks is highly valued by some buyers because of its investments in other companies, rather than just its role as a maker of bricks. Is this common among companies, and how much are we investing in the advertised business rather than their share portfolio? Effie, this isn't that common. Brickworks is quite a unique company in a couple of ways. Noel's right; it does have holdings in other companies, including one called Washington H. Soul Pattinson, which is one of the oldest pharmacy businesses in Australia, but also, like Brickworks, a holder of shares in lots of different other companies. So this is quite unusual, Noel. There's not many companies that act as sort of that have their own big share portfolios. And they sort of run this weird conglomerate model. And in fact, Brickworks and Washington H. Sol Pattinson own shares in each other. It's called a cross-shareholding. It's an old defense against takeovers that's still around for some reason. Brickworks, you need to treat it as rather unique, Noel. You're not going to see this. You're not going to see this regularly in the share market, and you do have to make it a distinction between their building materials business and the rest of their investments business. It's a weird one.
Yeah, okay. Andrew is a long-time podcast listener, but first-time caller, as he says. He's studying a graduate certificate in internal auditing with the Institute of Internal Auditors. Congratulations. I'm sure that's not an easy subject to get through. And he says he was surprised to read that under the Corporate Act, the external auditors are required to attend and answer questions at an AGM. He wants to know, has Stephen ever asked a question to an external auditor at an AGM? Now, I don't know Stephen, but I reckon he has. Any stories to tell? And he's also says, keep up the good work, Alan, and he'd like to see more skits with his son. It's great for improving financial literacy, and they are great skits. They
are. Chris does a great job, and the ones Alan's joined in have been terrific. Yes, I've been to a annual general meeting where the auditor's been asked a question. Often it's sort of clarifying. I reckon I've been to one where Stephen's asked a question too. They're very rare, and they're usually where companies have had some sort of financial issues. You know, there's a question thrown at the auditor about this or that. They can be quite picky from a retail shareholder who's got a particular bone to pick with the company.
Yeah.
It's actually good to see, like, the audited accounts. Having accounts signed off by an auditor is an important sort of protection.
It's part of the risk management process.
Yeah, that's right.
Absolutely.
And it's good to see that these guys come front up.
Yeah.
And if needed, investors can put a sort of face to the name.
And it's a great way for investors to be able to go to them and ask questions.
Yeah.
But I think the internal audit function, I'm not 100% sure, but I think it is based on the size of the structure of the company as well. I'm not sure if that applies to every company, but don't hold me on that one.
Yeah. Fiona says, I really enjoy your podcast and hear you talk about a number of trends that I thought might change the structure of finance and the market. I'm interested in what you think the market will look like in 10 to 20 years' time, given these trends, such as the rise in ETFs, the increase in businesses not going public, increase in investment by super funds, generational change, and the respective financial situations of those generations. This is a big philosophical question.
There's a lot to unpack there, Fiona. I do love this question, and I actually just came back from a 2-day COBA, the Mutual Banking Conference in Adelaide, James, and Simon Kustenmacher was there. He's the director and co-founder of the Demographics Group. And also with Bernard Salt. So his presentation was absolutely amazing. I did sit there and I took all these notes because his talk was all about what will Australia look like in 10 years' time. I got to say, James, I did walk away feeling a little bit depressed because the key takeouts from what I looked at was the gap between the rich and the poor is going to get wider. It's absolutely going to get wider. And there was a number of reasons why that was going to occur, and the intergenerational wealth, those that have it, that can pass it on, set the other generation up, those that don't, can't. It was also interesting to see that with the cost of education being where it is, and even the cost on TAFE courses, there's a lot of people he suspects that won't be able to afford TAFE education, so they move down in that bracket. The good news is he does think TAFE will be free within 10 years' time, because to try and get those people back into these courses to do that. No matter what we do, he says that we are going to have a shortage on skilled workers. Absolutely in the aged care sector, because of our ageing population. We are not going to be able to fill the workers situation, and we should be embracing technology because of that, because we are running out of skilled workers. So there was a couple of things there for me, thinking about, technology, what could I invest in further there? I mean, the aged care has been a problem for a long time, but what was interesting that he doesn't suspect that that's going to go away anytime soon, that we're going to have skilled labour shortages for a long time.
Yeah, and this is the difficult thing. We've got obviously a housing crisis at the moment. A lot of people say switching off or turning down immigration would be a great thing. But to your point, Effie, that just creates a different problem in 10 years' time, because we'll be low on skilled labour and our tax base will be eroding. So
absolutely. And it was interesting. He was saying, looking at basically those that have a high education typically will earn more. I don't know if I agree completely with that, but you've got 40% sitting in that top bracket, 46 sitting right down the bottom, and that middle Australia band is just disappearing, which is what he was trying to explain with the haves and the have-nots.
Yeah, just on the markets thing. I mean, Fiona's picked up some really interesting themes here. More and more money going to passive, so that can make markets. Some would argue that makes markets less efficient at pricing things, because the money's being run essentially by computers, or according to which companies are big rather than which companies are good, if that makes sense. The rise in super funds is going to be a really big thing for Australia. Obviously, the size of the super sector, is pretty rapidly heading towards $4 trillion.
Yeah.
The super funds could buy every listed company in Australia if they wanted to. They don't want to, and we hope they don't. But there is this question about how much harder it is to be a listed company as opposed to a private one. A lot more compliance and regulation and scrutiny. So I think Fiona's right, and I know regulators like Joe Longo at ASIC. He's really concerned about whether we end up with an economy that's got less publicly listed companies and more private companies. What does that do for the task of regulators, for the way information flows around the economy? I don't know if I've got answers, Fiona, but I think these are the questions. There's lots of questions that regulators and policymakers and people in the markets are trying to get their head around.
Yeah.
Tough one.
If I can just say to you, James, obviously the rise in ETFs, that's been absolutely crazy. We've had like over 200 billion go in there, funds under management there flowing through. I think it's also a sign of the times that people are looking for cost-effective ways to build wealth.
Yeah.
And with the barriers to entry in property, exchange-traded funds do represent another way that people can also start, diversifying, building wealth, and you don't need that, $200,000 deposit, so to speak, to jump in and look at that. But your point about super funds is very interesting too. I mean, they are also, because of their sheer size, limited to where they can invest.
Yes.
And that's going to be a big problem moving forward, because that's just one honeypot that continues. It's probably the best business model you can ever have.
Yep.
Your money just comes through the door.
Yeah, that's exactly right.
Yeah.
Your turn, Effie.
Okay, Michael asks, I'm not working but have investments earning me an income of about $55,000. That is a nice portfolio, Michael. And he wants to know, he'd like to add actually $5,000 to his superannuation annually. Can I claim this as a concessional superannuation contribution at 15%? I'm in my 50s. Well, first up, Michael, I've got to say I cannot give you personal advice. I'm not a financial advisor, but I can explain to you what concessional contributions are and what's considered a concessional contribution. Certainly, your super guarantee contributions made by your boss is a concessional contribution. The ones that you salary sacrifice, that's in the ones that you put in before your tax, those contributions are concessional contributions. And then contributions you make from your after-tax income, which that could be considered, can also be claimed as a deduction. Best thing is check with your accountant just to see your tax implications of what's happening there. But in general, they're the three things that can be considered as concessional super contributions.
Yeah, okay. There you go. Trent says, love the show. I was wondering what your thoughts were on Moncta Global, which was originally an unlisted fund and about 5 years ago established a listed fund. The funds appear to mirror each other in terms of the companies they invest in. The difference has been distributions paid. Up until 2023, the unlisted fund paid an annual distribution and the listed fund has paid half-yearly yearly distributions. For the 2003 and 2024 financial years, the unlisted fund has not paid a distribution at all. I can't help but think this is a way of pushing investors out of the unlisted fund and into the listed. Trent, I'm not sure about that. I think it would be a bit of a sense of horses for courses. So the unlisted fund will probably have investment sizes that you need to invest to get into the fund, which will be a bit larger than the listed fund, of course, where you could buy 1 or 2 shares if you wanted. So I don't think it's necessarily a way of pushing people out of one fund and into the other. It's more about Moncta being able to offer different things to different types of investors. That's my high-level view. I think that's what explains it.
Okay. Well, Ben's asking, we have a housing crisis. We talk about this as a consequence of COVID, but what actually changed during COVID that caused the crisis? The AFR today reported that it's due to the average number of residents in a household falling. It seems to be a no-brainer to me that changing the tax policy to allow people to rent out their spare bedroom tax-free would be a win-win.
Yeah, this is, the numbers, Ben's right, the numbers are really fascinating here. For the longest time, most of the last 40 years before the pandemic, we had about 2.8 people per household. And that has fallen in more recent times to around 2.3 people per household. You have less people in a household, you need more households, more homes. And so that has combined with this big increase during the pandemic in construction costs, in obviously more recently interest costs. So it's harder to build houses, get more houses out of the ground. So we've got these two forces colliding with each other. Ironically, if we got the average household back to 2.8%, to 2.8 people, I should say, we would actually have enough housing as it is. But will we go back towards that? I'm not sure. Maybe Ben's idea of letting people rent out their spare room tax-free would be a win-win. I'm not sure how many people would do that. But look, I think we've got to throw everything at the wall with the housing crisis and see what sticks. So maybe there would be some support for something like that, Ben. But the problem, Effie, is that it would turn us all into landlords, or lots of people into landlords, which brings its own complications.
Yeah, and that seems like a bigger fish to fry here for regards to the whole tax policy around the home and investment and so on. I just don't think any government is willing to tackle that, which I really do believe it needs to be. Interestingly, we talk about these rate cuts coming. I mean, this will only, I imagine, exacerbate the housing situation. If we do have these 4 or 5 rate cuts next year, what does that mean for the property prices? Because I tell you what, that they have just been remarkable. I know they're easing. I think the last time I looked at some data from CoreLogic, that, obviously depends on which state, and they're seeing a slowdown. But, you've got the likes of Perth and Brisbane that have just been on fire. And you look at lending statistics, and lending still holding up. Admittedly, probably more investors are jumping in than first-home buyers. But it surely will add more pressure to what is already a heated market.
And it's a real conundrum for Michelle Bullock and the RBA, because I think you're right. As soon as rates fall, we'll see some of these pent-up demand for homes as they become more affordable crystallise. Does she want to set a rocket under house prices again, which will flow through to rents, which, again, sort of pushes back up on inflation? It's a real issue. I mean, housing is, I said last week in the paper, housing is eating the economy. This is another example. Because we've got this housing problem, there's so many other economic levers that get influenced by where we are with housing.
And you raise a good point, James, when you talk about, the typical household has changed too, hasn't it? We do like our own space. We do, moving all back together under one roof just doesn't seem to be where we're going.
Yeah.
What I also find interesting is that you would think, for affordability, you'd maybe looking at more apartments and prices getting pressure there with apartments, but there's still such a big premium between houses and apartments.
Yeah.
In some cases, I think in Sydney, the premiums there looking at around like 70% difference between the medium house price and the medium unit price. So, we still want our spaces. We want our home rather than a unit. And as you've reported, that is putting pressure on the prices.
Yeah. I reckon we're getting towards time, Effie. I'm going to ask you this good one from Brad, though, because I reckon this is up your alley. Brad asks, should the government set up a superannuation for kids at birth? while child bonds exist, they're not well known, charge above market fees, and require some financial knowledge to set up. Why not establish a super fund for a child at birth with an initial deposit of $500 to $1,000 into the ASX 300? Cap contributions at $1,000 per annum until 18 to tax offsetting. This would provide an additional 18 years of compounding that ultimately takes burden off the social security costs while acting as an educational tool for future generations. What do you reckon of this?
I hope it takes the burden off the parents and they leave home. That's what I want. And I'm saying that loud because I've got a 23-year-old upstairs. No, to be fair to her, she's just come back temporarily. Look, this sounds fairly similar, doesn't it, James, to what the Liberals and Nationals were planning, weren't they, in New South Wales?
Right.
That idea that every child born in New South Wales would be eligible for a Kids Future Fund account.
Okay.
Managed by the New South Wales government. I thought it was actually a clever idea. It obviously didn't see the light of day. It sounds very similar that they get that $400 a deposit from the New South Wales government, and then parents and grandparents could contribute to it, and it would grow and so on. Look, the thing is, I do like the idea of forced savings. I like the concept of this. The fact is, with, millennials now and even younger, Generation Alpha, they are going to hit the ground running with the highest super guarantee we've ever had, because obviously, that's going up to 12%. And they'll have that from day one. The problem is, they're going to have probably over that 3 million cap by the time they retire anyway, without having to do anything because of that super guarantee is in there. I think that's in there already. Had this idea come out probably 10, 15 years ago, I'd be all over it. And I'm a big fan of super. But I think there'll be plenty in the kitty for the generation coming through the workforce with the super guarantee. I'd just like to see the government stop, stuffing around with it all the time. And I think I do like the concept of forced savings. And there, you've got your income bonds, your investment bonds, you've got your other investments, exchange traded funds that you can invest in and so on. There are lots of ways to build wealth, but I do like the concept of starting early, save little, save often is the key to wealth. Yeah.
No, it's an interesting idea. I'm with you though. Whether we almost get to a point where we've got too much in the way of forced savings, there'd be times like now when cost of living pressures are there, and you're thinking, well, 12.5% of my income's going into a super fund, and then I've got to whack some more money in into these child super accounts. Yeah, it's a tough one, but maybe that New South Wales idea might be one worth exploring. Maybe there'll be a brave government get that up at some stage.
Yeah. Well, that brings us to the end, doesn't it?
It does. It's been great fun.
That's very easy. I've really enjoyed my time here. Now, look, I believe you guys are up for an award, and the podcast, you can still vote for it. Look, do you want to talk about it, James? You've done all the hard work.
It's the Listener's Choice Award, which is part of the Australian Podcast Awards. I think you simply head to australianpodcastawards.com/voting, search for the Money Cafe with Alan Kohler, and then cast your vote and help us win.
Oh, you've got that in the bag. Everywhere I go, I know people really do enjoy Alan listening to you guys. It's a great little podcast you've got. So all the best with that one.
Oh, thanks, Effie. Very kind.
So on that note, guys, thanks for listening to today's episode of the Money Cafe. You'll be pleased to know that Alan will be back next week. So be sure to send in questions and the team will answer it together by emailing themoneycafe@eurekareport.com.au. Until then, I'm Effie Zahos, content officer and money commentator at the InvestSMART Group.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
Talk to you soon.